All right, so bonds have been one of the worst performing asset classes really since 2008, 2009. Okay, after those 2 years, bonds performed quite well, even in 2010, 2011. But ultimately, the Fed cut rates all the way down to zero, and they stayed there until about 2022. Inflation ran hot. The Fed had to increase interest rates. We all know what happened with bond prices. Bonds got destroyed in 2022. 60/40 portfolios were, completely useless at that, in that year from a diversification perspective. But in the fourth quarter, interest rates seem to have peaked. Okay, so the Fed began to cut interest rates in September of 2024, and they seem to have peaked in the fourth quarter, and now they're on the downward trend. And the question is, what is the role of fixed income? And so what I wanted to do is actually unpack the relationship of interest rates relative to bond prices, and I'm going to talk about three ways our clients are actually using fixed income as part of their retirement income plan. But before we jump into that, my name is Kevin Lau. I'm the host of the Planning for Retirement podcast, and I'm also the owner and financial planner at Imagine Financial Security. We help individuals over 50 with over $1 million maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. If that describes you, make sure to subscribe to our channel. We put out weekly retirement planning related content specifically designed to you, what I like to call PFR Nation. Okay, so we introduced this concept on the podcast this past week. I titled that podcast Bullish on Bonds. Okay. And listen, I'm not sitting here saying, let's go all in on fixed income. That is not the point of this podcast or this YouTube video. But ultimately, I've been hearing a lot about bonds from clients over the last, really for the last decade. Okay. Where clients are sort of like, hey, interest rates are super low. What is the role of fixed income in the portfolio? And so I wanted to introduce this concept and how fixed income could really be a great part of your portfolio, especially in light of some of the recent market volatility we've been having. There's a lot of uncertainty in the markets. With tariffs, April 2nd, sort of this liberation day. So the uncertainty around tariffs has really been spooking the markets because if inflation remains sticky, then the Feds may not cut interest rates. They may not be in a hurry to cut interest rates as aggressively as we thought they would going into 2025. So why don't we take a look at the history of the federal funds rate? Okay, so this is when we talk about rate cuts, this is exactly what that's impacting. And ultimately, this impacts all of the borrowing costs that banks have, and as well as consumers, businesses, et cetera. And what's interesting about this, if you look at really all of these recessions, all of these gray periods that are highlighted here, okay, so if you look at this one, this right here, all of these gray periods, if you look at these, they're generally preceded by the beginning of a rate cut environment. Okay, if you look right here, we had a recession, boom, and then rates were falling. Rates falling right before a recession. Rates falling right before a recession. Rates falling, kind of a little bit late into the recession, but really we're in the downward trend. And, sort of that cycle continues. And right now, here we are. We have not had a recession. So far, Powell and the Fed, we've been able to escape a recession at this point in time. But there's definitely a concern for a recession at this point. And so, ultimately, now we're on this downward trend of interest rates. And so now the question is, okay, well, if interest rates are on the downturn, what happens to stock prices and bond prices in those historical cycles? Like, what did stocks and bonds do during those periods of time? And this is exactly what we talked about on the podcast this past Tuesday. If you missed that episode, go check it out. It's called Bullish on Bonds. I'll link it to this video as well. But the red graph is the aggregate bond index. Okay, so the returns of the aggregate bond index, and then the blue bar is the S&P 500 returns. So what I did, and I talked about this on the podcast, what I did was I looked at those periods when interest rates peaked and then they began to cut. So at the beginning of the cut to the end, and generally there could be a lag in interest rates going down, meaning the Fed might cut rates, so they might cut their target rates, but sometimes it still takes a little bit of time for the Fed funds rate to follow suit, if that makes sense. And so what I measured was the beginning of the rate cut period up until the bottoming of actual interest rates, actual Fed funds rates, okay? And so if you look at the performance here, look at the ag here in 1988, or the period from 1981 to 1988. During that period of time, the ag returned over 13%, whereas the S&P 500 returned about 9.8%. So still a good period of time for stocks, but even better period of time for bonds. Okay. Let's look at the next period, 1989 to 1944. We had the ag returning about 9%, and then the S&P 500 returning about 9.5%. So just a narrow winner for stocks. Okay, but the bonds held up pretty well. I mean, we'll call that a tie, really, but at the end of the day, yes, the S&P 500 did beat this out. 2001 to 2004, bonds returned positive around 6.8%, and stocks were down about minus 0.25%. So a winner for bonds in that cycle. Let's look at 2007 to 2012. Bonds returned 6.1%, and stocks return about 2.5%. The period from 2019 to 2022 was a little bit odd because we had interest rates going up twice. Okay, so we had 2018 to 2019 interest rates were on the uptick, and then 2022 interest rates went up again. So we had this weird cycle of two rate increases in a 3-year period. So bonds in that period were flat, basically. We'll call it, positive 0.4%, and stocks were up significantly on positive about 13.1%. Okay, but if you look at this, 3 out of these 5 periods, bonds significantly overperformed stocks. One of those periods was basically a tie, and then one period was a significant outperformer for stocks. But that's the period where I think we're sort of still in this environment right now. I feel like, if we sort of extend this out another 5 or 6 years, it's going to be really interesting to see what happens. And the reason this is going to be really interesting to see what happens is because of the relationship with interest rates to bond prices. So I think this concept hopefully is going to make a lot of sense for you all as you think about why bonds have been such an underperformer over the last 10, 15 years, and why it could be a really good part of your portfolio as we look forward into the future. And that's this relationship between bond prices and interest rates. Okay, so if interest rates go up, bond prices go down. Okay, so why is that the case? Okay, let's look at this one. So if interest rate, let's say you have $1,000 bond. Okay, so your bond's worth $1,000, and let's say it's paying a 2% coupon. Okay, so we're in a relatively low interest rate environment. Let's say this was at the beginning of 2022. That was probably a pretty reasonable coupon rate to have received. Okay, so when interest rates go up, now let's say rates are now at 3%. Okay, so now someone can buy this same $1,000 bond, and the crediting rate is 3% on that one. Who would ever want to buy your bond for $1,000? Okay, the only way someone's going to buy your bond is if you discount the price. So the bond price would have to go down. You would have to be discounted. Okay, so I don't know, somewhere in the neighborhood of $900. And this depends on a lot of factors. It depends on the duration of that bond. It depends on how many years into the maturity is that bond. But there are a lot of factors that go into that. But ultimately, the bond price is going to have to come down. Okay, so therefore this is now on par. So now you can buy a discounted bond for $900 because that's only crediting 2% relative to current markets. You can go out and buy a $1,000 bond for 3%. So the values have to be equal. But if you bought that $1,000 bond that was crediting 2% and you needed or wanted to sell it to raise capital or raise cash for a liquidity need, you're going to have a discounted price. Okay, you're probably going to lose maybe 8 or 10% of its value depending on, again, the maturity of that particular bond. But what about if interest rates go down? So if interest rates go down, let's say you have a $1,000 bond and it was crediting 4%. Okay, that's the coupon rate. Okay, so let's say interest rates were cut, and now that same $1,000 bond is being issued for 3%. Well, now this bond is very valuable. Okay, people are going to want to buy that bond because it's paying 4%. Therefore, the price of this one is going to have to go up because no one in their right mind would sell it at par value when they could probably sell it for $1,100, okay, as opposed to $1,000. So now that price went up by about 10%, okay? And this makes sense, again, because the open market is now generating a 3% coupon rate. If someone wanted your 4% bond, they're going to have to pay a premium for it, okay? And therefore, bond prices would go up. So if you think of where we are in the cycle right now with interest rates on the downward trend, the question is, how might bonds react on a go-forward basis? Okay. Now, I don't have a crystal ball. I'm not saying I'm predicting that bonds are going to outperform stocks here going forward for the next period of years. But again, I'm trying to address this question that many of our clients have, which is, should you own bonds, and where do bonds fit in an overall well-diversified portfolio? So there are three ways our clients are using fixed income in their portfolio. And I think the first one is really the obvious one, which is, reduce volatility. Okay. So if someone was entering retirement and they had 100% of their portfolio in stocks, their portfolio is going to be fairly volatile. They might not feel super comfortable with significant ups and downs. I mean, if you go back to 2008, stocks dropped by more than 50%. So how is that feeling if someone retires with $2 million and all of a sudden their portfolio is worth $1 million 12 months later? That probably wouldn't feel very good. Okay. So therefore, bonds just serve as a volatility buffer. If you had a 60-40 portfolio in 2008, bonds returned 6% that year. Okay. So you did not have a 50% drop in your portfolio. It was still probably painful, maybe a downturn of 25 or 30%, but certainly not a 50% drop in your portfolio. So I think that reduced volatility ultimately just allows retirees to sleep better at night, knowing that not all of their portfolio is going to be on the roller coaster of the stock market. So the second thing is this concept of dry powder. You've probably heard the notion you want to be buying low and selling high. Okay. So if you're in retirement and you are, looking at rebalancing your portfolio, certainly you may not be adding more money to the portfolio. You're not working anymore. You're not taking your paycheck to buying into the portfolio. So if stocks drop when you're in the accumulation phase, of course, you're going to be adding cash to the portfolio to buy stocks at discounted prices and take advantage of those dips. Whereas if you are retired, you may not be adding more money to the portfolio, but the asset on the fixed income side, assuming it's not 100% correlated to stocks, can be used as an asset to turn into cash and buy stocks at discounted prices during periods of volatility, like 2025 so far. We've had corrections on both the NASDAQ and the S&P 500. If you have fixed income in your portfolio, that's actually returned a positive return year to date. That could be a place where you could go for income, but it could also be a place where you could use as a rebalancing tool. And then the third piece is this concept of asset dedication. Okay. And this could be used with either individual bonds, bond funds, CDs, tips. I mean, there are a lot of different fixed income instruments you can use, but the idea of asset dedication is to essentially have a specific dollar amount in the fixed income side that's dedicated to generating your retirement income cash flows for a period of time. If you want to get super conservative, it could be upwards of 8 to 10 years. If you're, I would say more reasonable, it's maybe 3 to 5 years of your cash flow needs in fixed income. So that way, if you have a significant downturn in the stock market, like let's say 2008, 2009, it took about 4 years for the markets to recover. Maybe you have 4 or 5 years of your income needs in retirement in the fixed income side of the portfolio, so you're not forced to sell out of stocks in a down market. Now, the question is, how much exposure should one have in fixed income? And that answer, I don't have for you, because again, I'm talking on a video. I don't know who's listening, and ultimately everyone has a different situation. Everyone has different goals, risk tolerance, risk capacity. But ultimately, sort of that tried and true portfolio is 60-40 for retirees, 60% in stocks, 40% in fixed income. But we have clients that are 100% in the stock market, that are officially retired. And the reason for that is because they have Social Security payments and pension that's really taking care of the majority of their fixed income needs. So they can be super aggressive to try to really grow their portfolio over the next 10 or 15 years. On the flip side, we have clients that have that same situation, but they also want to be defensive because they feel like they've won the game. They don't need or want to take on a lot of risk in the market. So again, it kind of comes back to this risk tolerance, risk capacity conversation. But I think if you sort of go into that asset dedication mindset where you say, hey, you know what, I need $100,000 a year for cash flows over the next 5 years. Maybe you have $500,000 in fixed income. So if your portfolio is, let's say, $2 million, that would be at least 25% of your portfolio on the fixed income side and then 75% on the equity side. Again, I'm not saying that is the right allocation for you. What we like to do is start with the financial plan, start with the goals, start with the risk tolerance, start with the risk capacity, and then back into the income sources. What are the Social Security payments? What are the pension payments, if any? And then ultimately, how much income are we going to need to rely on the portfolio over the next 3 to 5 years? And that typically will drive how much we have on the fixed income side of the ledger, if you will. But again, there's no right or wrong answer on this one. But one thing I would caution a lot of you is don't get too conservative too quickly. Okay, this is a big thing. I see a lot of retirees. they sort of approach retirement, or they get to retirement and think they need to go super defensive. And I think this is a big mistake a lot of people make, is because, it brings inflation risk into the picture. It brings interest rate risk more into the picture. And ultimately, if you have the tolerance and the capacity to at least be 60% in equities, 40% in fixed income, that can help you combat that inflation risk. Again, if you are more on the conservative side. But if you want to get more aggressive, you can certainly dial up the equity exposure. Just make sure you have an adequate amount of fixed income for additional volatility protection, for rebalancing opportunities with that dry powder, as well as for income dedication, asset dedication. So I hope you all found this helpful. If you liked this video, make sure to like the video. And of course, make sure to share this with somebody that you know and care about that is approaching retirement, who has recently retired and is maybe curious about, hey, how much, should I own bonds? How much should I own in bonds? And of course, make sure to subscribe to our channel if you're in that PFR Nation sweet spot, over 50, over $1 million saved for retirement. This content is specifically dedicated for you. Until next week, I'll see you then.